Good day, friends. CEV welcomes you for watching this video. Please do not forget to like, comment, and subscribe our YouTube channel, Registered Values Club, for getting all new professional updates. So, in this video, we will discuss about how you can use accounting and bookkeeping in your day-to-day work. Especially, this is important for values who are registered with IBP or who are preparing for IBBI examination for land and building. So we will be discussing how the bookkeeping principles will be applied for analysis and cost management techniques. This document provides the essential financial frameworks that support accurate property valuation. Each section includes real-world examples relevant to the Indian valuation context, practical applications, and professional insights to strengthen your valuation practice, as well as you will learn why it was important that you have to learn this accounting during your IBBI 50 hours training. So those who are preparing for the examination, they will learn why it is important and how and where these bookkeeping principles will be used during their examination, as well as when they become registered values during their practice as a registered value. First thing, and as far the syllabus of IBBA examination is concerned, you have to learn fundamentals of bookkeeping. Means what is the meaning of bookkeeping? So bookkeeping basically it is a systematic recording, storing, and retrieving of financial transactions pertaining to a business or organization. So this is what is meant by bookkeeping. Means systematically recording, storing, and retrieving the financial transactions of the business or organization of which you are dealing with. So as far as IBBA registered values for land and building is concerned, understanding the bookkeeping is crucial as it provides you the financial foundation upon which the property valuations are built. So after going through these contents of this video, you will learn how this bookkeeping and other terms related with bookkeeping and accounting will help you in improving your valuation practice. First thing you have to learn is what is recording transactions. So recording transaction means bookkeeping involves method methodical documentation of all financial transactions, including property acquisitions, sales, maintenance expenses, rental income, and capital improvement. So whatever is done by the firm or the business regarding any transaction, that has to be recorded, and there are certain methods of recording them. So that methodical documentation of all financial transactions is called recording of transactions. Then financial controls. What is financial controls and how it is that bookkeeping will help you in financial control? So proper bookkeeping provides control over finances by tracking all monetary flows related to the real estate assets, preventing frauds, errors, and financial discrepancies. Then, of course, it is important that bookkeeping is to be done as to complete the legal compliance. So bookkeeping ensures compliances with the statutory requirements under Companies Act Income Tax Act, and of course under IBBI regulations, which is essential for valuation professionals. And then based upon all the documentations, you one have can make decision, and that decision has to be supported by the various things which are contained in the records of books of the firm. So accurate financial records support financial decision and informed decision making during valuation assignment by providing historical data on the property performance and cost basis. So we will take an example that how the proper bookkeeping will help you. For a land and building valuer, a proper bookkeeping is indispensable when analyzing income producing property. So it is generally most important, especially in case of income generating or income producing properties. For example, when valuing a commercial building in Mumbai's Bandra Kurla complex, a valuer must review properties' financial records to understand rental histories, maintenance and expenditures, and capital improvement costs over time. So the financial record provides critical input for income capitalization approaches to the valuation. So I think fundamental or basics of the bookkeeping is clear to you, and how it is helpful in valuation. Next thing you have to learn is double entry bookkeeping system. So this is an important thing. So what is double entry for bookkeeping system? The double entry bookkeeping system is a foundation of modern accounting based upon the principle that, so this is basic thing which you have to learn about bookkeeping, a double entry bookkeeping system, that every financial transaction affects at least two accounts. Double entry book system, the principle of double entry bookkeeping system is that every financial transaction affects at least two accounts. So for IBBI values, the system ensures complete and balanced financial records that provide reliable data for property valuations. So debit entry, there are certain debit entries, there are certain credit entries. So debit entries, what it does, it increase assets or expenses, and credit entries is it increases liability and or equity. So balance double entry, what it done, that in case of balance double entry, debit entries are equals to credit entries. That is the most important thing. So core principle of double entry book. Under the system, each transaction must maintain the account equation. This is the basic account equation which you must remember. That is the important thing you must remember. Assets is equals to liability plus owner's equity. For every debt entry, for every debit entry, there must be an equal credit entry, ensuring that books always balance. So the double entry system provides a self-checking mechanism that is invaluable for valuation professionals who must rely on accurate financial data to develop credible property valuations. So we will try to clear the above core principles with the help of a real world application for values. Consider a valuer assessing a rental apartment building in Pune worth 12 crore. When reviewing owner's books, the valuer should see what the valuer should see. First thing he should see original purchase price was recorded as debt to the building asset, that is 12, and a corresponding credit to either cash or loan payable. So as we know, in double entry system, there are this entry should be at least at two places. So one thing is that purchase of the property is debited in the building assets as 12 crore and a corresponding credit is done in the cash or loan payable accounts. So subsequent rental income transactions would show debit to cash and credit to rental income. So these balance entries allow valuer to verify property's income history, essential for using income approach to the valuation. So I think it is clear now why it is important. So understanding double entry bookkeeping enables valuers to detect inconsistencies in financial records that might affect valuation outcome. For example, misclassified capital improvement recorded as repairs and maintenance expenses could lead to understanding a property's book value, potentially affecting the cost approach valuation. Next is books of prime entry and subsidiary books. So for IBBI Registered Valuer, understanding the organizations of accounting records is essential when examining a property's financial history. Accounting system utilize various books to record different types of transactions, creating a structured record bookkeeping system that supports accurate property valuations. So there are different types of books as we have already discussed. There are certain books which are called books of prime entry. So initial recording of all transactions are done in books of prime entry. These books are such as journal, cash book, and bank book. And then subsidiary books. They are specialized records for specific transaction types such as sale book or purchase book, etc. And then ledger. Ledger is final classified record of all accounts and transactions. And financial statements. Financial statements are summary reports such as balance sheet, income statements, which are used in the valuation report. So first we will discuss about the primary books which are used especially in real estate accounting. When analyzing a property owner's financial records, valuer should be familiar with these key books. So as a land and building valuer, you should be familiar with these key books. First is cash book. So what is done in the cash book? The cash book record all cash receipts and payments, which includes rental collection, security deposits, and cash disbursement for property expenses. Second primary type of book is bank book. So what it does, it documents all banking transactions related to the property, including mortgage payments, electronic rent deposits, and check issued for repairs, etc. Then journal, what it does, it records non-regular transactions such as depreciation entries, assets revaluation, and year-end adjustment that affect property value. Then ledger. So ledger is the principal book that contains separate accounts for land, building improvements, rental income, property taxes, and other relevant categories. Then purchase book. Purchase book records all credit purchases related to the property, such as construction materials or maintenance supplies bought on credit. Then sales book, it documents all credit sales which the real estate might include rental agreements where payment is due later. Then debit and credit note register. So what it does, it records adjustment to purchase or sales such as rent concession or additional charges for property related services. So for example, ways you can use these books to make the things clear, we will be taking a real world example. For example, a valuer is examining a commercial property in Bangalore's track corridor. These books provides critical insight into the property's financial performance, maintenance history, and capital improvement, all factors that influence the final valuation of the. Now I
Incoming voice
will
call from
discuss in
BTW.
detail cash book and bank book. Next is cash book and bank book. So what is cash book? So now we have learned the basic books. Now we will try to have some details about these books. First we will discuss about cash book. So cash book, what we do with the cash book? It record the immediate transactions. So the cash book, it serves both as a journal and a ledger account for cash transaction. For property values, cash book provides valuable insights into day-to-day cash flows associated with the property. There are different types of cash book which are commonly encountered. First type is simple cash book. It records only cash receipts and payments. Then there are two column cash book. It contains separate column for cash and discount transactions. And then three column cash book. It includes column for cash, bank and discount transactions. So next type is book, bank book. So what it does, it helps in tracking financial institution transactions. So the bank book records all transactions processed through the property owner's bank accounts, including checks issued, deposits made, electronic transfers, and bank charges. So a comprehensive bank book is particularly important when valuing income producing property as it verifies the regularity and stability of rental income, if key factor in income approach valuation. So we will be discussing a real world example that will make the things clear to you about these books. When valuing a 50-unit apartment complex in Noida, an IBBI value reviews three-column cash book to analyze a property's operational cash flows. The cash book reveals that rental collection amounts to rupees 25 lakh monthly, with the consistent cash flows of rupees 8 lakh for maintenance, 3 lakh for property taxes, and 7 lakh for staff salaries. The bank column shows regular mortgage payments of rupees 12 lakh monthly. So this data allows the values to calculate the net operating income accurately, essentially for applying to income capitalization approach. The discount column reveals that the property owner offers a 5% discount to the tenants who pay quarterly in advance, affecting the effective gross income calculations. So, with the help of this cash book, you can analyze the property cash flow from where you can have knowledge about the net operating income of from the property. Then next type of book is journal and its role in property accounting. The journal, it is often called the book of original entry. So it serves as a chronological record of transactions that do not fit into specialized books like cash book or purchase book. For value, property value is a journal contains valuable information about non-routine transactions that can significantly affect or impact the property value. So what are the key entries which are relevant to the property valuation, which are there or which may be there in the journal? First thing is asset revaluation. So entries that adjust the carrying value of land and building based on periodical assessments. Then depreciation entries, annual or quarterly recording of the building depreciation that affect the book value. Then capital improvement. Capital improvements means major renovations or improvements that enhance property's value or extended useful life. Then write-offs. Write-offs means adjustment for property damage, obsolescence, or impairment. So see, there is difference between depreciation entries and write-offs. So depreciation, it records the building's depreciation, whereas write-off, it is adjustment for property damage, obsolescence, or impairment of the property. Then accrual or rent prepayments. End of the period adjustment for expenses like property taxes or insurance that are called accrual or prepayments, and then loan restructuring. So changes to the mortgage terms that affect the property's debt services. So this is what the journal entries may affect the property valuations, which are relevant to the property valuation. So now we will discuss about the format of journal entry. So a standard journal entry includes date, account name and course, debt and credit amounts, and a narration explaining the transaction. So for property related entry, detailed narrations are particularly important as they provide context that helps valuers understand the nature and purpose of transactions. For example, journal entry for a building renovation. So it is done on March 15, 2023. It, it is done in the recorded in the building improvement account, and 45 lakh is debited. So credit is to the bank account 45 lakh. So being a major renovation of the west wing of the new electrical systems, HVA upgrades and interior finishes to meet modern office standards. So this is how the journal entry is made. So for an IBBI registered valuer who is preparing for the examination or who is evaluating a commercial property in Gurgaon business districts, this journal entry provides critical information about capital expenditure that enhance property's value. So the detailed narration helps the value understand the scope of improvements, allowing for accurate adjustment when using the cost approach to the valuation. Next type of book is ledger. It is an important book. So classification and organization of accounts. Basically, that is the thing which ledger contains. The ledger is a principal book of accounts that contains all accounts in a classified and permanent form. For IBBI registered values, the ledger provides a structured view of property's financial history organized by account categories rather than chronological order. So ledger may have different parts: capital or equity part, assets, liability, expenses, income. They are there in the one book which is called ledger. So ledger organization for property accounting. In property accounting, the ledger typically contains three major sections. these major section. First section is asset accounts that contains land, building, furniture, and fixture equipment details. Then liability account, which contains mortgage payables, security deposits held, and account payables. Then income accounts, it have the details of rental income, parking fees, service charges, utility recoveries. Then expense account, which contains property taxes, insurance, repairs and maintenance, utilities and management fees, etc. And then capital account, the owner's equity, retained earnings, and capital improvement. So these are the different sections which a ledger may have. So the process of posting to the ledger, how the recording is done or posted in the ledger. Posting is the process of transferring entries from the books of original entry to the respective ledger account for property accounting. So this ensures that all transactions affecting a particular account such as rental income, building repairs are consolidated in one place. So that is why recording is done, to have all the transactions which are affecting a particular account, they are consolidated in one place. You will be taking a real world example that will make the things clear about the ledger. Let us suppose we take the example of a office building in Chennai. When valuing a six-story building office situated in Chennai's IT corridor, IBBI Value examines the property's ledger to understand its financial performance. The rental income ledger account shows monthly credits totaling 1.2 crore annually, with a steady growth of 8% growth over the past 3 years. The building maintenance account reveals annual debts of approximately 35 lakh, with a significant increase of 52 lakh in the most recent years. Further investigation of the narration of the accounts reveals major HVAC systems overhaul, which the valuer notes as a non-recurring expense. The property tax account shows consistent annual payment of rupees 18 lakh. So these ledger accounts provides organized data that allows the valuers to calculate normalized operating expenses and stabilized income, crucial inputs for the income capitalization approach to the valuation. Next is purchase and sale books in property management. So what the purchase book does, it keeps a tracking of all credit acquisitions. The purchase book, it is also known as purchase journal. It records all credit purchases related to property operations and maintenance. While cash purchases are recorded in the cash book, credit purchases are first entered in the purchase book before being posted to the ledger. What are the relevant entry for property values in the purchase book? You have to check for construction material acquired on credit, maintenance supplies from regular vendors, service contracts with the deferred payment items, fixtures and equipment purchase on account, landscaping material and services on credit terms. And second type of book is sales book, which document all credit revenue. So the sale book records all credit sale transactions. In property management, this primarily includes rental agreements where payment is due later and not received immediately in cash. So typical entry in real estate context are rental agreement with payment terms, tenant improvements to be reimbursed later, service charges billed to the tenants, common area maintenance charges, and parking fees billed monthly. Next type of book is debit and credit notes register. So the register records adjustments to the previously recorded purchases or sale transactions are called debit and credit notes register. So what is debit note? It is issued when returning goods to the supplier or claiming price adjustment for services. For example, when returning unused construction material or requesting credit for substandard maintenance services. Then next is credit note. It is issued to the customer for returns or price adjustment. In property management, this might include rent concessions, adjustment for the service interruptions, or corrections to the overcharged common area maintenance fees. For example, we will be taking a case studies that will make the things clear to you. Case studies of a mixed use development in Hyderabad. An IBBI valuer who is assessing a mixed-use development in Hyderabad's Jubilee Hills, examine the purchase book to understand that property's maintenance practices. The book reveals regular credit purchases from a single HVAC vendor totaling rupees 18 lakh annually, suggesting a comprehensive maintenance contract that should contribute to the extended equipment life. The sales book shows that retail tenants are billed for common area maintenance charges quarterly in advance, creating a predictable cash flow pattern. The debit credit notes register indicates minimal adjustments, suggesting that stable operations with few disputes. So this information helps the values to assess properties management quality and operational stability factors that influence the capitalization rate applied in the above income approach to the valuation. Then writing of books. Writing of books means recording practices and principles. So fundamental recording principles for property accounting are proper writing of books refers to the systematic and accurate recording of financial transactions following established accounting principles. For IBBI registered values, understanding these practices is essential when reviewing financial records for valuation purposes. First thing is these should be in chronological orders. All the transactions must be recorded in strict date sequence to maintain an accurate timeline for financial events affecting the property. Then complete informations. Each entry must contain all relevant details, date, description, reference number, accounts affected, and amounts. And then proper authorization. Entry should be supported by authorized source documents such as invoices, contracts, or payment vouchers. And all the recording should give clear narrations. So description should be clearly explain the nature and the purpose of transactions, particularly for unusual or significant items affecting the property value. So what are the document requirements? Accurate book writing requires proper documentations to support each entry. For property related transactions, these typically includes next is documentation requirements. So accurate book writing requires proper documentation to support each entry. For properly related property related transactions, these typically include purchase invoice. So when you are purchasing materials, supplies or services which are to be used in property maintenance, their invoices are to be recorded. Then rent receipts, documentation of rental income collected, then property tax notices, supporting proper tax payment entries, then utility bills such as electricity, water supply, etc., documenting operational expenses. contracts for ongoing service arrangements or tenant leases, then bank statement for verifying financial transactions, and appraisal reports for supporting revaluation entries. So we'll be taking a real world examples that will make you conversant with this factor. Rec- Record keeping of a hotel property. So when valuing a 200 room hotel property in Goa, an IBBI valuer notes exceptional record keeping practices that enhance data reliability. Each month's financial transactions are recorded chronologically in the journal with clear reference to the supporting documents. Capital improvements such as recent 2.5 crore lobby renovations are documented with detailed contractor invoices, architectural plans, and before and after photographs. The properties chart of accounts is structured to separate revenue streams such as rooms, food and beverages, spa, events, etc., allowing for detailed departmental profitability analysis. The meticulous recording practice provides a value with high quality data for applying the income approach, particularly when developing the discount cash flow models that require detailed historical performance of the project for future income streams. Next topic is posting and closing of accounts. First, we will discuss what is posting process. Posting is the process of transferring entries from the books of original entry to the respective ledger account. So first, whatever the entries are, they are made in the books account and then they are transferred to the respective ledger account. So for property accounting, this systematic transfer ensures that all the transactions affecting specific aspects of the property are consolidated in one place for analysis. What are the steps in posting process? First thing is you have to identify the entry. So locate the entry in the book of original entry. Means whether it is a journal, cash book, etc. You have to locate that entry. Then you have to locate the relevant ledger account. Then you have to transfer the same entry with the same date as in the original data to the respective relevant ledger account. And the amount is also either it is appropriately debited or credited to the respective column. Then you have to give a summary of a brief description of the entry if it is needed. Then you have to know the page number of the original book also for reference cross indexing and update the running balance of the account. So this is the process how the posting is done in the ledger. For example, you have a property maintenance account. Original journal entry was on date 10th April 2023. It is building maintenance account and 25,000 was debited and it was credited to APC contractors account. So it is an entry of being quarterly HVAC maintenance. Now this posting is done in the building maintenance ledger. Date is 10th April 2023 to APC contractor J15 is the ledger folio number. 85,000 is the amount. So balance is 4,28,000 debited. So it is again posted in the ABC contractors ledger on the same date April 10, 2023 for built by building maintenance J15 ledger folio number 85,000 is the amount, so balance amount is 85,000 is correct. So this is how posting is done from the original book to the ledger account. Then next thing you have to know is closing of account. So what is closing of account? So first we will discuss that. At the end of each accounting period, typically monthly, quarterly, or annually, as the case may be, accounts must be closed to determine the financial results for that period. So basically, they are closed, and the purpose is to find the financial result for that particular period, whether it is at monthly, quarterly, or annually. So this process is particularly important for property accounting as it produces financial statements used in the valuation. First thing is balance calculation. So calculate the final balance of each ledger. See here, you have to calculate the final balance of each ledger account by totaling debits and credits. Then you have to prepare trial balance to create a list of all ledger accounts with their debt and credit balances to verify their account's accuracy. This is called trial balance preparation. Then adjustment of entries. So record accruals, key payments, depreciation, and other adjusted entries. And then you prepare financial statement. So transfer the account balances to trading and profit loss and balance sheet statement. So after these three steps, then the financial statements in the form of trading and profit loss and balance sheet statement is prepared, and then closing of entries is done, means transfer income and expense account balances to the profit and loss account. So while you are preparing for IBBI examination or as a valuer you are preparing any valuation as an IBBI value, you have to analyze these all these things for preparation of valuation or for preparation of your examination. So we will be taking an example. For example, when you are analyzing a retail property in Kolkata's prime shopping district, a the closing process creates period and financial statements that reveals trends in the rental income, vacancy rates, and operating expenses, which are critical inputs for developing a credible valuation opinion. So now we will discuss about the trading account and profit and loss account. That will make the things more clear. So first we will discuss about trading account. So purpose of this is basically very direct property operations. Trading account is basically measurement of direct property operations. A trading account is a financial statement that calculates the gross profit or loss from the trading activities by comparing direct revenue with the cost of goods sold. So this is basically what is a trading account. So it is used for calculating the gross profit or loss from where? From trading activities. What are the trading activities and how it is done? By comparing direct revenue with the cost of goods sold. So while traditionally used in merchandising business, trading accounts have applications in property management, particularly for properties with direct operational components. So how this trading account is applied in property valuation? For IBBA valuers, trading accounts are most relevant when valuing these types of property, hotels and hospitalities, where room revenues are offset by the direct costs like housekeeping, amenities, and reservation system. Next is service apartment with the direct service cost associated with short-term stays. In case of retail properties and revenue sharing, where landlords participate in tenancies. In case of event venues, with direct cost for each function, and in case of co-working spaces where membership revenues offset direct operational costs. So what now we will discuss the structure of a property trading account. Okay, this is an example of a trading account for lakeside resort and spa for the period for the year ended on March 31st, 2023. Columns are particulars which give the details, then amount. So this is how you have to do trading account. So on the left side you have the expenditure, and on the right side you have the revenue. So to opening stock 8,50,000, to direct wages 95 lakh, to food and beverages 78 lakh, to guest amenities 25 lakh, to laundry services 32 lakh, to reservation systems 18 lakh, and then on the right side are they have earned from room services 4 lakh 85,000, by food and beverages they have earned 2 lakh 25,000, and then from spa and recreation 185 lakh, by event space rental 65 lakh, by closing stock just applies they have 10 lakh 50,000. So the gross profit is 5 lakh 14,000. So total on left side is 7 lakhs 7 4 70 lakh 50,000, and right side it is again 7 4 70 lakh 50,000. So how this is used in the valuation. See in this example, gross profit of rupees 51.15 crore. It represents a contribution from direct operations before accounting for overhead expenses. For an IBBI valuer using the profit method of valuation common for operational property, this gross profit figure is a critical input. So this valuer will then deduct the overhead expenses from the gross profit to determine the net operating income, which would be capitalized at an appropriate rate to estimate the property's value. So understanding trading account allows valuers to normalize financial performance by identifying and adjusting for unusual non-recurring direct costs that might distort the property's typical operating results. Next is profit and loss account. So this is basically used for measuring properties performance, how the property is performing. So the profit and loss account, it is also known as the income statement. It summarizes a property's revenue, expenses, and resulting profit or loss over a specific period. For a RBBI registered values, the profit and loss account provides critical insights into a property's operational performance and income generating capacity. What are the structures of and components of properties profit and loss account? There are three sections. One is revenue section, second is the expense section, third one is non-operating items. In the revenue sections you have earnings from rental income, which is base rent, then common area maintenance recoveries, property tax recoveries, parking income, and other income such as from signage, events, etc. Then expenses may be property taxes, insurance premium, utilities non-recoverable, repairs and maintenance, property management fees, legal and professional fees, marketing and leasing costs. Then non-operating cost items are interest expense, depreciation, amortization of leasing cost, gain or losses on the disposal of assets, and extraordinary items. So we will be taking a real world example that will make the things clear. We are a office building whose profit and loss account analysis will be done. Considered an IBBI valuer assessing a 10th floor office building in Bengaluru's Whitefield area. The property's annual profit loss account statement is like this is basic rental income, cost and common area maintenance recoveries, tax recoveries, parking income, and total income. So total expenses reviews that total operating expenses are 240 lakh, resulting in a net operating income of 440 lakh, 445 lakh. So the value of note that yes, maintenance expenses include one-time HVAC system overhaul costing rupees 35 lakh. For valuation purposes, valuers normalizes our net operating income by spreading this cost over the HVAC system's 10-year expected life. So adding 31.5 lakh, 90% of one-time cost to this net operating income. So how it will be applied in the valuation? So on using a normalized value of instead of 440 lakh net operating income, we will add 31.5 lakhs in it to add one-time cost that will be for 10 years expected life, 90% of it is added in it. So for 76.5 lakhs and applying a capitalization rate of 8% based on market comparables for similar officer properties in Whitefield, the value estimates the property value by using income capitalization approach, 476.5 divided by 0.08. So the value is 5956.25 lakhs or approximately 59.56 crore. So this example demonstrates how IBBI values must carefully analyze P&L statement to identify and adjust for the unusual or non-recurring items that could distort the valuation results. Next is income and expenditure account for non-profit properties. So the income and expenditure account is the non-profit equivalent for a profit and loss account. It is used by non-commercial entities. So instead of profit and loss account in case of non-profit commercial entities such as educational institutions, hospitals, clubs, and religious organizations. So this is used for non-commercial entities. For IBBI registered value, understanding this statement is crucial when valuing properties owned and operated by non-profit entities. So key difference. What are the key differences from loss and profit account? So we will discuss about in case of purpose. Income and expenditure accounts will show you surplus or deficit, but in case of profit and loss account, it will be shown as profit and loss. Then terminology. Here we will be calling income, expenditure, surplus, deficit. But here we, in case of profit and loss, we will call it revenue, expenses, profit or loss. Then capital treatment. Surplus is added to the capital fund, whereas profit is distributed to the owners. So surplus is not distributed to anyone, it is added to the capital fund, while profit is distributed to the owners. Then the focus is on service delivery's effectiveness. And in this case, profit and loss account, focus is on commercial performance of the company. Then what are the items to be included? All revenue receipts and payments are to be included. And in case of profit and loss account, you have to add trading and operational items. We will be taking an example that will make the things clear for income and expenditure account of an educational institution valuation, how it is to be used. An IBBI valuer is tasked with valuing a 5-acre educational campus in Dehradun with multiple buildings. The income and expenditure accounts reveals tuition fees they have earned is 4.2 crore, hostel fees 1.8 crore, grants and donations from the government and other sources 2.5 crore, investment income 0.8 crore, facilities rentals for the events etc. zero point 0.5 crore. So total income if you add is 9.8 crore. Then expenditure categories, they have staff salaries of 5.4 crore, building maintenance they have spent 1.2 crore, on utilities they have spent 0.8 crore, for educational supplies they have spent 0.9 crore, on administration 0.7 crore, and the depreciation of building is 0.6 crore. So total expenditure is 8.7 crore. So the resulting surplus is 1.1 crore. It is not profit, it is resulting surplus. 89.8 point minus 8.7, 1.1 crore. So unlike commercial properties where the income approach directly capitalize the net operating income, the value takes a different approach for this educational institution. If you are using cost approach, it is primary method calculating replacement cost of the building 65 crore less depreciation 12 crore plus land value 45 crore. The resulting value is 98 crore. If you if the valuer was using cost approach. But if he is using modified income approach, the valuer analyze the portion of the income derived from the property related sources such as hostel fees and facility rental totaling 2.3 crore and applies a capitalization of 10% to this income stream, suggesting a value component of 23 crore for this income producing element. So this is the difference. See here, the value with the cost approach comes out to be 98 crore, but with modified income approach, so this is important. What are the things which you have to take into consideration while calculating the income? So here only two things they have they taken into consideration. That is 1.8 crore, which is hostel fees, which is earned from the property, and facility rentals 0.8 crore means 2.3 crore. That is to be taken into account. Not all the incomes are to be taken into account while calculating the value from property point of view. So the value reconciles these approaches, giving the primary way to the cost approach while considering the income of producing capability, arriving at a final valuation of 90 crore, 5 crore from the educational campus. So this is how you can use different methods to arrive at a particular best result because you are using both the methods. It is not that you will be giving the minimum or average or that, then based upon your experience, you have to give a value which is relevant for a particular case. Then primary analysis of financial statements, how it is carried out. So primary analysis of financial statement is a critical stage for IBBI registered values as it provides initial insights into a property's financial health and performance trends. This analysis forms the foundation for more detailed valuation approaches and helps identify areas requiring further investigation. So next topic is what are the key financial statements which a valuer should look for when he's doing property valuation? First thing is to look for his balance sheet. So what he can look from the balance sheet, he can find from the balance sheet is because it provides a snapshot of assets, liability, and owner's equity at a specific point in time. Means at the point time where he is to carry out his valuation, we can get the details of the assets of and liabilities and owner's equity in that property. So for property valuation, this reveals the book value of real estate assets, associated liabilities like mortgages and equity position. Second thing, if he is doing valuation for some non-commercial property, he has to look for income statement, P and L, and income and expenditure for non-commercial property, and he is to look for profit and loss account for commercial property. So from here he can get the details about the revenues, expenses, and resulting profit or loss or surplus or deficit over a particular period. So this statement reveals the property's income generating capacity and expense structure. Then cash flow statement. So from the cash flow statement, the valuer can track cash movement categorized as operating, investing, and financing activities. So this helps valuers to understand actual cash generation separate from the accounting profits. And then notes to the financial statements. So it provides detailed explanation of accounting policies and additional information about specific items. So these notes often contain critical details about properties, valuation methods, impairments, or contingent liabilities. Next is essential analytical techniques, how you can do analysis of all the things which we have discussed. First one is there are two many things in analysis. uh, Basically we can divide the analysis into three parts. One is horizontal analysis, second part is there are next item is essential analytical techniques. So there are three types of analysis particularly which is important for a value. First one is horizontal analysis, then vertical analysis, and ratio analysis for the properties. So we will discuss them one by one. What is horizontal analysis? So a horizontal analysis is basically comparing financial data over multiple periods to identify trends and growth patterns. For example, analyzing a year's rental income might reveal steady growth of 5% annually, suggesting a stable property with a reliable income escalation. And then vertical analysis it is used to express each item as a percentage of base figure, typically total revenue or total asset. For example, for a commercial property, this might show that property taxes represent 15% of total revenue, following comparison with the industry benchmark. And then ratio analysis for the property. Ratio analysis, there are different types of ratios analysis. Net operating income margin ratio, that is ratio of net operating income to the effective gross income. Second ratio analysis is operating expense ratio, that is operating expenses divided by effective gross income. See here it is in net operating income you have to take net operating income and effective gross income. But in operating expense ratio you have to take operating expenses and effective gross income. And then debt service coverage ratio, it is ratio of net operating income to annual debt service. And then return on asset means how much return the property is generating from the asset. It is a ratio of net income to the total asset. And then occupancy rate means occupied space divided by total leasable area or total leasable space. So we will take it with an example. Let us suppose a valuer is valuing a 3,50,000 square feet retail mart in Amritsar and IBBI Valuer conducts a preliminary financial analysis and notes several key findings. The horizontal analysis reveals declining year-over-year total rental income minus 0.8% in the most recent year, despite stable occupancy rates. It means what is being done? It means that rental concessions are being given to the tenants to retain the tenants. And then from the vertical analysis, it shows that common area maintenance expenses represent 25% of the total operating expenses, significantly 18% higher than the 18% benchmark for similar properties in the market, indicating potential inefficiencies. And then debt service coverage ratio has decreased from 1.8 to 1.3 over 3 years, but still it is higher than the minimum 1.2, suggesting increased financial stress. Then capital expenditure have been minimal for the 5 consecutive years, raising concerns about the deferred maintenance that might affect the future performance. So based upon the preliminary analysis, based valuer decide to apply a slightly higher capitalization rate than the market average. Means instead of 8.75, we decided to apply a 9.5% capitalization rate to account for the identified risk when using income approach. Additionally, the value plans detailed discussion with the management about the CAM expenses, common area maintenance expenses, anomalies, and potential deferred maintenance issues to refine the valuation opinion. Now we will discuss about the different ratio analysis in the property valuation that will make the things clear. So ratio analysis is an essential tool for IBBI registered valuers to assess properties' financial performance, identify trends, and compare against the industry benchmark. So these quantitative measures provides valuable insights that influence approaches and assumptions. So different types of key valuation ratios are, first one is profitability ratio. Profitability ratio, as we have already discussed, net operating income margin. So what it does, it measures the operational efficiency by dividing the net operating income with effective gross income. Higher the net operating income ratio, it indicates the better cost control. So formula is net operating income divided by effective gross income. For example, a commercial property with net operating income of 3.5 crore and effective gross income of 5 crore has a net operating margin of 70%, indicating strong operational efficiency compared to the average of market average of 6.65%. Then expense ratios, operating expense ratio, it is shows what proportion of revenue is consumed by operating expenses. Low ratio suggests more efficient property management. So formula is operating expenses divided by effective gross income. For example, a residential apartment building with operating expenses of 1.42 crore and effective gross income of 4 crore has an operating expense ratio of 30%, which is favorable as compared to the market average of 35%. And then next is debt service ratio. Debt service coverage ratio, it measures the property's ability to cover debt payments. So values below 1 indicates insufficient cash flows to service debt. So net operating income divided by annual debt service. A hotel property, for example, a hotel property with net operating income of 5 crore and annual debt service of 3.2 crore has a debt service coverage ratio of 1.56, suggesting adequate coverage of debt obligations. Then return ratio means cash on cash returns. It measures the pre-tax cash flow relative to the initial cash invested. Higher ratios indicate better cash flow. Formula is annual pre-tax cash flow divided by total cash invested. For example, an industrial property generating an annual pre-tax cash flow of 1.5 crore on cash investment of rupees 10 crore has a cash on cash investment of 15%, is 10 crore divided by 1.5 crore divided by 10 crore. So next is our operational performance ratios. There are different operational performance ratios. First one is occupancy rate. Occupancy rate formula for this ratio is occupied space divided by total leasable space. How, what it signifies, it indicates demand for the property and effectiveness of leasing strategies. It directly impacts the income projections. The next one is turnover rate. Turnover rate means number of move outs divided by total units. So what it reflects is it reflects tenant satisfaction and property management effectiveness. Higher turnover increases expenses and vacancy losses. So it should be minimum. Occupancy rate should be maximum, turnover rate should be minimum, then revenue per square feet. So total revenue divided by gross leasable area. It measures the revenue efficiency space utilization. It is useful for comparison with similar properties. Then expense per square feet. So expense per square feet, it is total expenses divided by gross leasable area. So it measures the cost efficiency of the property operations. It helps to identify expense anomalies. We will be taking an example that will make the things clear. An IBBI valuer analyzing a 2,50,000 square feet grade A office building in Mumbai's Bandra Kulra complex calculate the key ratios as net operating. This is net operating margin. This is operating expense ratio. This is basically this shows subject property and this shows market trends. Similarly, operating expenses, this is subject properties, operating expenses ratio, this is market average. And see there revenue per square feet and expenses per square feet. See here, it is lower. So when you compare these, so this on the basis of this ratio analysis, which has been drawn on the graph from where you can analyze that in every field it is either equal or better than the market average. So we will be applying lower capitalization rate in this case. So based upon the ratio analysis, the valuer conclude property demonstrate above average operational efficiency and revenue generations. So these favorable operational metrics support using a capitalization rate to 25 base points lower than the typical market rate of 8%. So when applying the income capitalization approach, resulting in higher valuation of the property. Next topic is cost and costing. It is basically fundamentals for the values. So far we have been concentrating on income approach. Now we will be dealing with the other approaches also. So this cost and costing, first thing is you must understand the difference between them. You must understand their definition and it is particularly important when you are using cost approach to the valuation. Cost accounting principles provide framework for analyzing and categorizing various expenses associated with the property development, maintenance, and operation. So basic concept is you must understand what is the definition of cost. Cost you understand that cost represents the monetary value of resources sacrificed or foregone to achieve a specific object. So in the context of real estate, we can say cost include all expenditures involved in acquiring, developing, maintaining, and operating a property. Now we will discuss about definition of costing. Costing is the process of determining the cost associated with a particular product, service, or activity. So, for example, in property valuation, costing involves systematically analyzing and allocating expenses to understand the true cost basis of a property. We will learn the difference between them within some examples. First, we will discuss about the different definitions or different types of cost based upon their behavior, based upon their relevance to the property valuation. So first we will discuss about the cost classification based upon the relevance to the property valuation. First, by nature means there may be material cost. Material cost means construction of material, fixtures, etc. Then there is labor cost means construction workers, property staff, etc. Then expenses may be utility expenses, insurance, professional fees, etc. Then by name, by time, historical cost means actual cost occurred previously. Current cost means present day cost, which is you may call it as replacement cost. And future cost means projected expenses for the improvements. Then by function, production cost means construction and development. Administrative cost means property management, and selling costs which are associated with marketing and leasing expenses. Then based upon the behavior, we can classify the cost as fixed cost. Fixed cost means those costs which means constant. Fixed cost, it remains constant regardless of occupancy or usage level. For example, property taxes, insurance, depreciation, etc. They are called or they comes under the heading of fixed cost. Then variable cost. Variable cost changes in proportion to occupancy or usage level. For example, utilities, cleaning services, maintenance of material. And then there are certain costs which are both fixed and variable. They are called semi-variable cost. They contains both fixed and variable component. For example, staff salaries with performance bonuses, utility bill with fixed connection charges. So we will be taking an example that will make the things clear. And we will take the example of an industrial warehouse valuation where a valuer is appraising a 1 lakh square feet industrial warehouse in Ahmedabad DIDC area using the cost approach. So valuer analyzes the following cost component. So land value we find out on the basis of a comparable sales which was 4.5 crore. Building hard cost. Building hard cost means replacement cost, which is approximately 2,500 per square feet for similar construction quality, and they multiply it with the plinth area, so the building hard cost is 25 crore. Soft cost, which is related to the architectural, engineering permits and financing, etc. It is 15% of hard cost. Means 15% of 25 crore, it is 3.75 crore. And developers' profit is 12% of combined hard and soft cost, that is uh, 0.3.45 crore altogether, means 15% of 28.75 crore. So total reproduction cost will be, you add all the three, so total cost comes out to be reproduction cost or replacement cost 32.2 crore. Accurate depreciation is 25% on the basis of the age and condition. So it is a 25% of 32.2 crore, it is 8.05 crore. So depreciated value of the building comes out to be 24.15 crore, 32.2 minus 8.05. So total value of the property is 4.5 crore plus 24.15 crore, it is 28.65 crore. This is land plus depreciated value of the building. So this case demonstrates how understanding the various cost components and their classification is essential for implementing the cost approach to valuation, particularly for special purpose properties where market data may be limited. Then we will now discuss about the various elements of the cost. First, we will discuss about the fixed component. Expenses, fixed expenses are those expenses that remains constant regardless of property's occupancy level or operational intensity. For IBBI registered valuers, identifying and analyzing fixed expenses is crucial for accurate financial modeling and valuation, particularly when using income-based approaches. So, what are the characteristics of fixed expenses? They remain constant over relevant ranges of activity or time periods. They do not fluctuate with the occupancy or usage levels. They are often contractual or statutory in nature. They are typically time related rather than activity related, and per unit cost decreases as the activity level increases. So common fixed expenses in the property operations are property taxes. These are the taxes which are based upon the assessed value. So these taxes remains constant regardless of the occupancy. Annual property taxes for a commercial building in Gurugram may range from 50 to 100 rupees per square feet, representing a 15 to 20% of the operating expenses. Then insurance premium. So property and the liability insurance costs are typically fixed annually. A multi-story residential apartment building in Chennai might pay rupees 2 to 3 lakh annually for comprehensive coverage, regardless of the vacancy rates. Then fixed surface contracts. So many times there are ANC, that is annual maintenance contracts for elevators, HVAC systems, and security services. They have often fixed cost. A 15-story office, for example, office tower in Pune might spend 18 to 20 lakh annually on elevator maintenance contracts regardless of the building usage. Then debt services. Debt services depend upon the mortgage and principal and interest payments. They remain fixed for fixed rate of loans. A retail mall with the rupees 50 crore loan at 9% interest might have fixed amount debt services of approximately 5.5 crores. So how these fixed expenses are used in the valuation? The valuation implications of fixed expenses. Fixed expenses have several important implications for property valuation. First, operating leverage. Properties with high fixed expenses experiences greater profit volatility in response to revenue changes. The risk factor may warrant high capitalization rate. So if the high operating expenses or fixed expenses are higher, they will offer greater profit volatility, and hence in that case capitalization rate will be higher. Then break-even analysis. So that we will discuss about the break-even analysis in the coming slide. Here you must understand that properties with the high fixed expenses require higher occupancy levels to break even, affecting risk assessment. So what is break even? We will discuss in the coming slides. Then expense ratio analysis. The ratio of fixed to variable expenses impacts the property's operational flexibility and risk profile. Then normalization adjustments. So valuers must identify non-recurring fixed expenses for normalization when developing income projections. We will be taking an example of a photo property in Jaipur that would clear many things. And IBBI Value is analyzing a 150 rooms luxury hotel in Jaipur, identifies the annual fixed expenses as below. Fixed expenses category and amount and percentage of total expenses they have calculated. So property taxes are 85 lakh, it is 11% of the total expenses. Insurance 35 lakh, it is 4.5% of the total expenses. Then maintenance, management salary is 1 crore 20 lakh, it is 15.5% of the total expenses. Franchisee fees, it is fixed component, 75 lakh, it is 9.5% of the total expenses. Similarly, equipment maintenance cost 50 lakhs, which is having 6.5%. Marketing minimum contractual, it is annual amount is 60 lakh, which is approximately 7.5% of the total expenses. And debt services 3 crore 50 lakh, which is 45.5%. Means total fixed expenses are 7 crore 75 lakh, which means this is the percentage of total expenses of each and every fixed expenses. So with the annual room revenue of 18 crore and the food and beverages revenue of 7 crore, the value calculates that the hotel needs to maintain at least 58% of occupancy to cover the fixed expenses. So the high fixed expenses structure increases the property sensitivity to market downturns, leading the value to apply slightly higher capitalization rate, 10.5%, 10.5% of the market, whereas the market average is 10%. So when using this income approach to the valuation, so this this is 58% occupancy means to cover this fixed expenses of 7 crore 75 lakh, at least the rooms 150 of the 150 rooms 58% occupancy should be there, so that at least these fixed expenses are covered. So how this will be used in the coming slide, we will discuss that. Then the second element of the cost is variable expenses. So variable expenses they fluctuate in direct proportion to the property's occupancy, usage or activity level. So for a IBBI registered value, understanding of the variable expenses is essential for accurate financial modeling, particularly when projecting performance under different occupancy scenarios. So characteristics of variable expenses. Characteristics of variable expenses we will discuss now. The first one is proportional fluctuation. So what is proportional fluctuation? So it changes directly with the property activity level of occupancy rate. So as the occupancy increases, the variable expenses will increase. So they increases proportionately. So unit consistency. So cost per unit activity remains relatively constant. So per unit cost means per unit cost which is on the, if you discuss about the example of this hotel. So per unit cost of per room, if we say the variable cost will almost remain constant. Then zero to zero activity. So theoretically, no cost is incurred when activity completely ceases. So though it may not be practically possible, but theoretically it is assumed that if no activity or if the activity completely ceases, it will not cause any cost. Then divisibility. It can be assigned to specific operational functions or tenants. So commonly variable expenses are, we will now discuss and how with the help of some real world examples. For example, utilities. So electricity, water and gas consumption that varies with the occupancy and uses. For example, a 2 lakh square feet mall in Lucknow spends 12 to 15 rupees per square feet monthly on electricity, with the cost dropping by 30% when the occupancy falls from 90 to 60%. Then cleaning services. So cleaning services means supplies used for routine repairs and upkeep that vary with the building uses. So for example, a hotel in Goa sees maintenance material cost fluctuates from rupees 2000 to 3500 per room annually based upon the occupancy levels. Then variable staff wages. So part-time or hourly employees whose schedules adjust with the property needs. For example, a residential complex in Mumbai reduces security staff during a low occupancy period, saving about 1.2 lakh monthly. Then management fees. So percentage-based fees that vary with the collected revenue. A commercial property, for example, with a 4% management fees pay rupees 5 lakh when monthly collections are 1 crore, but only 3 lakh when the collection drop to 75 lakh. So these are some of the variable expenses. They varies with the proportionately with the property operations. Then semi-variable expenses. So many property expenses they have both fixed and variable components, making them semi-variables or mixed expenses. For accurate analysis, value should be separate these components, for such as staff cost. So base salaries are fixed plus sometime performance bonus is given or overtime is given. So this is both fixed and variable type cost. Then utility. So connection fees are minimum charges plus consumption based charges are variable. So as you know in the electricity bill, as the number of units consumed increases, the rate also increases. So, but minimum fixed charges are to be paid. Similarly, for in case of maintenance, preventive maintenance contact are fixed, and plus usage based repairs wherever required, they are variable. For example, we take the example of a study of an office building, variable expenses analysis, and a IBBI valuer analyzing a 12 1 lakh 20,000 square feet office building in Hyderabad city examines the how expenses varies with the occupancy. So occupancy rate is given in the percentage. You, this color is used for utilities in rupees. This is cleaning in rupees. Then this is material maintenance material. So if we analyze this based on the analysis, the value determines that approximately 65% of the building's total operating expenses are variable. Current occupancy is 75%, but the market research suggests occupancy dropped to 65% due to new competing properties. So by understanding the variable expenses structure, the valuer can accurately project how the operating income would be affected by the potential occupancy decline. So resulting in more realistic valuation account that accounts for the market risks. Then break-even point analysis, that is an important component in bookkeeping for the values. So first we will discuss what is break-even point analysis, especially in case of property valuation. Break-even point BEP analysis is a powerful tool for IBBI registered values to assess property's financial viability and risk profile. It determines the occupancy level or revenue needed for property to cover all expenses without generating profit or loss. So see, it determines the occupancy level or revenue needed for a property to cover all expenses without generating profit or loss. Means all the fixed and for covering all the fixed and variable and semi-fixed variable cost, what minimum occupancy rate is required, that is break-even point. So break-even formula for property analysis, uh, revenue break-even point. So first we will calculate it from the revenue generated, then we will try it from occupancy point of view. So total revenue required to cover all expenses will be fixed expenses plus divided by contribution margin ratio. So what is contribution margin ratio? Contribution margin ratio is revenue minus variable expenses divided by revenue. So this is break even point, revenue break even point. It is fixed expenses divided by contribution margin ratio. So though in BEP revenue you see it is only fixed expenses, but in the contribution margin ratio these terms revenue. So in contribution margin ratio it is revenue minus variable expenses divided by revenue. So the second is occupancy break-even point. So occupancy break level required to cover all expenses is equals to fixed expenses divided by average rent per unit minus variable expenses per unit. So where this break-even point analysis is used for application in different types of property types, how it is used. In residential rental properties, it determines the minimum occupancy needed to cover mortgage, property taxes, insurance, and fixed maintenance contracts. So it helps to assess the risk of negative cash flow during market downturn. In case of hotels and hospitality, it establishes the minimum occupancy rate or average daily rate needed to cover all high fixed expenses, particularly important for seasonal property. And in case of commercial office buildings, it calculates the minimum lease rate or occupancy level required to cover debt services and operating expenses, guides leasing strategies and concession limits. Then, in case of retail properties, it determines the minimum sale volume needed for percentage rent leases to become profitable for the landlords, or the minimum occupancy for base rent to cover all the expenses. So we will take an example that will make the things clear. A hotel property in Agra. An IBBI valuer analyzes a 120-room hotel near Taj Mahal with the following financial structure. Annual fixed expenses are 4.5 crore, including debt service, property taxes, insurance, franchise fees, and management salary. Annual average daily rate is rupees 5,500 per night. Variable expenses are 1,800 per occupied room per night, including housekeeping, utilities, gas supplies, and reservation fees. Then contribution margin per room per night is rupees 3,700. So means this is the collection or revenue from the hotel, and this is expenses. So contribution margin per room per night will be 5,500 minus 1,800. It is a 3,700. So total available rooms annually, how much there are? 120 rooms multiplied by 365. So annually 43,800 rooms are available throughout the night. So BEP room night is equals to fixed expenses divided by contribution margin per room per night. So it is 4 crore 50 lakh divided by rupees 3,700, 12,162 room nights. So out of for available 43,800, minimum occupation of the rooms should be 12,162 rooms. So it means break-even occupancy percentage is 12,162 divided by 43,800. It is 27.8%. So what are the valuation implications of this break-even point? So relatively low break-even occupancy of 27.8% suggests property has good downside protection. It can remain financially viable even during the financial market downturns. So valuer notes that local story market's historical low occupancy during the off season is 35%, indicating that the property should remain above break even throughout the years. So the favorable risk profile scores using a slightly slower, lower, higher capitalization rate 9.75 versus a market average of 10% when applying income approach to the valuation. So the valuer also performs sensitivity analysis to assess how potential ADR decreases would affect the break-even point. A 10% drop in the ADR to rupees 4,950 would increase the break-even occupancy to 32.5%, still below the historical market low, further confirming property's resilient financial structure. Next is cost volume profit analysis for property investment. What is cost volume profit analysis? Cost volume profit analysis extends beyond basic break-even calculations to examine how changes in the cost, occupancy, and rental rates affect a property's profitability. For IBBI registered values, CVP analysis So CVR analysis provides insight into the property's operating leverage and sensitivity to the market fluctuation. So first, we will discuss about the key component of CVP analysis. First is classify cost, then contribution margin, break even, sensitivity, risk, and resilience. We will discuss all these terms in the coming slides. So CVP formula for property analysis. First is contribution margin. Contribution margin, it is equals to revenue minus variable expenses. That is called contribution margin. Then CM ratio. CM ratio, it is a uh, huh? CM ratio means the contribution margin ratio. It is calculated by dividing revenue minus variable expenses with the revenue. And then target profit calculation, it is calculated by dividing fixed expenses plus a desired profit with this contribution margin per unit. And then for margin of safety, the formula is front revenue minus break-even revenue divided by current revenue. And then degree of leverage, it is contribution margin divided by profit. How these CVPs are used, we will be taking a practical application where they are practically used. They are used for calculating the rental rate decisions, means analyzing how potential rental change rate would change of or affect profitability. Then acquisition analysis, determining the maximum purchase price that would allow a property to achieve its targeted returns. Then renovation decision making means if you have done some renovation, then how the increased fixed costs, debt services for improvement, balanced against the potential rent increases, and how it affects the profitability. And then for risk assessment means quantifying a property's vulnerability ability to the market downturns. For example, the IBBI valuer is analyzing a 1,50,000 square feet office building in Pune with the following financial parameters. Annual fixed expenses are 4.8 crore. Variable expenses per square feet if it is fully occupied is 120 rupees per year per square feet means. Average rental rate is 750 rupees per square feet per year. And the current occupancy is 85% means 1,27,500 square feet, 85% of 1,50,000. Now see how we will be calculating CVP or how will be carrying out comprehensive CVP analysis. See what is contribution margin. Contribution margin means he is getting an annual rent of 750 and he is spending variable expenses of 120 rupees. So the contribution margin is 630 rupees per square feet. CM ratio, contribution margin ratio is rupees 630 divided by earning 750. So contribution margin ratio is 84%. Now see how break even occupancy is calculated. So and it is annual fixed expenses 4.8 crore divided by rupees 630 which is a contribution margin ratio. It is 76,190 square feet means if there is 50.8% occupancy then the owner will be able to get back the annual fixed expenses. Then current profit is the occupancy is 1,77,500 and per square feet rate is 630 rupees. So minus 4.8 crore which are the annual fixed expenses. So current profit is 3.23 crores. So margin of safety see if current occupancy rate is 85% in even if he is able to get 50.8% then he will be able to get the annual fixed expenses covered. So 85% divided by 85% current occupancy rate, so 40.2% is the margin of safety. So and degree of operating leverage means 1,27,500 square feet multiplied by 630. So 3.23 crore by divided by 3.23 crore, which is current profit. So degree of operating leverage is 2.49. So see from this analysis what we can interpret. This analysis interprets that the property has a comfortable margin of safety 40.2%, indicating resilience against market downturns. Then degree of operating leverage DOL 2.49. It means 10% change in the occupancy rate would result in approximately 24.9% change in the profit, indicating moderate operating leverage. And then current occupancy rate is 85%, which is significantly higher than the break-even point of 50.8%, suggesting strong financial performance. So based upon this analysis, the valuer determines the property has a favorable risk profile, supporting the use of a capitalization rate lower than the market rate of average 8.5%. He can use 8.25% when applying the income approach to the valuation. So this is how we apply CVP in case of office buildings. Now we will discuss about how the CVP analysis is applied in developing projects to check their viability. So cost volume profit analysis is particularly valuable for evaluating real estate development projects. For IBBI registered valuers engaged in valuing development land projects under construction, CVP analysis helps assess financial feasibility and risk profile of the proposed development. So, adapting CVP for development projects, what are the key modifications which are to be done for developing analysis? First is units of analysis. So typically square feet of built up area or number of units they are chosen as the unit of analysis. Then fixed cost. What are the fixed costs in case of one project? Land acquisition cost, approval cost, design and project management, and financing cost. And variable costs are construction material, labor, marketing per unit. Then revenue is expected selling price per square feet or per unit. And time dimensions, incorporation of project timeline and phasing. So these are the modifications we will do in case of development projects. So we will similarly these modifications will be applied to the CVP formulas. Contribution per margin per unit in this case will be selling price minus value variable construction cost per unit. Break even number of units, that will be fixed number of fixed developed costs divided by contribution margin per unit. Then break even selling price fixed cost divided by number of units plus variable cost per unit. Then target profit calculation is equals to fixed cost plus desired profit divided by contribution margin per unit. So we will take an example that will make the things clear. An IBBI valuer is analyzing a residential development in Navi Mumbai with the following parameters. The total area of the land per development is 5 acres. Number of 250 number of units are planned for 2 and 3 BHK apartments. Land cost is 40 crore including stamp duty and registration charges. And other fixed costs are 35 crore approvals, design, management, and financing. So variable cost and revenue projections are as under construction cost is to be 3,200 per square feet. Average unit size is 1,200 square feet. Marketing cost is 200 rupees per square feet. Total variable cost will be 3,200 plus to 200, 34, 3,400 per square feet, or you multiply it with the then 1200 average unit size. So average total variable cost is 40.8 lakh per unit, and expected selling is rupees 8,500 per square feet. Means if you multiply 8,500 with the 1200, it is 1.02 crore per unit. So see here, what is contribution margin per unit? So 1.02 crore is the expected selling price and the variable cost is 40.8. So contribution margin is 61.2 lakh per unit. Then break even number of units. So 75 crore C is the total fixed cost 40 crore plus 35 crore. We divide it with the 61.2, which is contribution margin per unit. It is 123 units, means 49% of the total units when sold, they will be able to cover the fixed cost. Then projected profit at full sell-out, when fully settled, there will be 250 units, and per unit contribution margin is 61.2 lakh minus 75 crore is the fixed cost, so 78 crore will be the profit. So margin of safety 250 units, out of which even if 123 units are sold, divided by 250 means 51% what is our margin of safety. So if we do sensitivity analysis, the valuer examines how the changes in the selling price would affect the project's break-even point. So selling price, so as our selling price is 8,500, if we do it for different selling price, we calculate break-even given for different selling price and draw a graph from where we can analyze the analysis. And then from the CVB analysis, we conclude that the project requires 129 3 units, means 49% of the total to break even, indicating moderate risk. Market adoption data suggests this area is typically selling 30 to 35 units per quarter, meaning break even should occur within 12 months of the launch. Means in 3 months there is 30 to 35 units, means nearly within 4 months they will be able to achieve break even target. And then 51% margin of safety provides adequate buffer against the market fluctuations. And then even if the selling price is dropped by 10% to 7,650 per square feet, the project remains viable with the break even point of 171 units, means 68%. So the valuer uses analysis to support a land valuation of 45 crore using the residual method, representing a premium over the original 40 crore land cost due to the project's favorable financial metrics and developers' progress in obtaining approvals. Next is fixed and variable cost analysis for different property types. So the proportion and behavior of fixed versus the variable cost vary significantly across property type, directly implicating operational risk, variable in valuation approaches, and investment strategies. So, as a IBBI registered valuer or as a person who are uh, preparing for examination, they must understand these cost structures to accurately assess the different property classes. But in case of hotels, generally fixed costs represent 60 to 70% of the total expenses, including property taxes, insurance, franchisee fees, management salaries, debt services, market commitments. So high fixed costs create significant operating leverage and volatility. And in case of office building, fixed costs are generally 55 to 65% of the total expenses, including property taxes, insurance, base building maintenance, management salaries, and debt services. Most utilities and cleaning costs vary with the occupancy. And in case of retail properties, the fixed costs are generally varies from 50 to 60% of the total expenses, including property taxes, insurance, common area maintenance, security, and debt service. Mall properties tend to have higher fixed costs than the strip centers. Then, in case of residential apartment, the fixed costs are represent 40 to 50, 45 to 55% of the total expenses, including property taxes, insurance, administrative staff, landscaping, contracts, and debt services. A higher proportion cost varies with the occupancy. And then in case of industrial property, the fixed cost typically varies account for just 35 to 40% of the total expenses, as these properties have lower service requirement and often pass through many expenses to the tenants. So this creates lower operating leverage and more stable returns. So what will be the impact of the valuation? So fixed variable cost mix significantly impact several aspects of the property valuation. So in case of capitalization rate, higher cap rates to account for greater operational risk and earning volatility. And if there are high fixed cost properties, then you have to adopt higher cap rates. And if the high variable cost properties, then you have to adopt lower cap rates reflecting more stable and predictable cash flows. Then income projections. In case of high fixed cost property, greater normalization is required across economic cycles to account for volatility. And in case of high variable cost properties, you require more conservation vacancy provisions, a more direct use of recent performance as predictor of future results. And vacancy of allowance in case of high fixed cost properties, you require higher vacancy provisions to account for increased impact of vacancies. And in case of high variable cost property, you require more conservative vacancy provisions as impact is partially offset by reduced expenses. Market sensitivity. In case of high fixed cost property, you require more detailed market analysis required to assess potential occupancy fluctuation. And in case of high variable cost property, you require less sensitive to short-term market fluctuations. So we will take an example that will make things clear. Comparative analysis of two properties. An IBBI valuer is analyzing two similar sized properties in Pune. A 150 rooms hotel and a 1 lakh square feet industrial warehouse. Both properties generate approximately 12 crore in annual revenue, but their cost structures are differ dramatically. In case of hotel property, fixed expenses are 6.8 crore, means 68% of the total. But in case of industrial property, only 3.6 crore, 36% of the total. And in case variable expenses are 3.2 crore, approximately 32% of the total. And here variable expenses are 6.4 crore, approximately 64% of the total. And then break up even occupancy 63%, here breakover occupancy is 40%. And profit at 70% occupancy is 0.75 crore. And in profit at 70% occupancy, here in this case, industrial property is 1.5 crore. Profit at 80% occupancy, 2 crore. Profit at 80% occupancy, industrial property has 2.1 crore profit. And operating leverage, it is 5.4%, means 10% occupancy change causes 54% profit change. And it is 2.5%, means 10% occupancy changes causes 21% profit change. Now see here, total property, if we apply different capitalization rates, we have to reflect the distinct risk profiles. So in case of hotel properties, he applies a 10.5% capitalization rate to stabilize net operating income of 2 crore, resulting in a value estimate of 19.05 crore. And he applied 8.5% capitalization rate to establish net operating income of 2.1 crore, resulting in a value estimate of 227.24.7 crore. See here how the values differs. So despite similar revenue and a slightly higher net operating income for the hotel at peak performance, the industrial property receives a higher valuation due to its more favorable cost structure, lower break-even point, and a reduced sensitivity to the market fluctuations, all factors that reduce investment risk. Next is marginal costing and its application in property valuation. So first we will discuss what is marginal costing. Marginal costing is a technique that distinguishes between fixed and variable costs to understand how cost and profit changes with different levels of activity. For IBBI registered valuers are those who are preparing to become registered valuer. Marginal costing provides valuable insight for decision making in the property valuation, particularly when analyzing income producing properties under various scenarios. Now, first of all, we will discuss about the key concepts in marginal costing. So, what is marginal costing? Marginal costing, the additional cost incurred to produce one more unit of output or service, one additional tenant, guest, etc. we can say. So that is marginal costing, means for adding one unit or for adding one additional tenant, one additional cost guest. So the cost or the additional cost that will be required, that is called marginal costing. Then contribution margin, the difference between revenue and variable cost that contributes to covering fixed cost and generating profit, that is called contribution margin. Then another thing which is important for the values is P over V ratio. P over V ratio means profit over volume ratio. That measures the rate at which profit increases with the increasing volume. That is contribution divided by sales. So that is called P over V ratio. And margin of safety. The excess of actual or projected sales over break-even sales, indicating the cushion against the losses, that is margin of safety. How it is applied in property valuation? First, it is used for rental rate decision making. On the basis of it, rental rate is decided. So, marginal costing helps to determine the minimum acceptable rental rate for vacant spaces. For example, if a commercial property has a vacant space with a marginal cost of rupees 150 rupees per square feet annually, any rental above this amount contribute to fixed cost and profit, even if below the standard rate. For example, for a vertical office space with marginal cost of rupees 150 per square feet and market rate of 500 rupees per square feet, accepting 350 square feet during the market downturn still generates positive contribution. So see here what is the use of marginal costing. And then it is also used for property expansion analysis. So when evaluating property expansions or renovations, marginal costing helps isolate the incremental cost and revenue associated with the expansion. For example, adding 20 rooms to an existing hotel might cost rupees 3 crore with an incremental rent revenue of 1.2 crore annually and marginal operating cost of rupees 45 lakh, generating a contribution of 75 lakh and a 25% return on the investment. So additional applications of marginal costing is we can decide on whether we should lease the property or whether we should sell the property. So to make the decision between lease versus sell decision, so determining whether to lease or sell a property based on marginal contribution analysis, then tenant mix of optimization. It means analyzing the contribution margin of different tenants type to optimize commercial property performance. It may also be used for seasonal pricing strategies, for developing pricing strategies for seasonal property based on marginal cost consideration, and then for offering special offers and concession. So evaluating the financial impact of rental concession, free rent periods, or tenant improvements. So we will take an example that will make the things clear. Let us suppose an IBBI valuer is advising on a 500,000 square feet retail mall in Gurgaon with a 15,000 square feet anchor space vacant for 6 months. The mall has two potential tenants. So we will be considering different parameter. First, offered rent per square feet monthly is premium fashion retailer. He is offering 180 rupees per square feet, and discount department store it is offering rupees 120 rupees per square feet. Then lease term, this is 3 years with 15% escalation. Then second, this is 9 year with 12% escalation every 3 years. Then tenant improvement contribution rupees 2000 per square feet, approximately 3 crore rupees per total, and with 15,000 into 2,000, and this is 500 rupees per square feet means approximately 75 lakh total. Expected foot traffic generation, it is moderate, it will generate high foot traffic. Then impact on the adjacent store sale, it will be approximately 5% estimated, and in this case it will be 12% estimated. So now you have to make analysis on the basis of which you may decide that the valuer performs a marginal analysis to determine which tenants create more value. First, direct revenue comparison. The premium retailer offers 3.24 crore annually rent versus 2.16 crore discount rate. See here the rate 120 into 15,000 and 120 but 15,000 into 120. So then tenant improvement impact. The premium retailer requires 2.25 crore more in upfront costs. See here it is 3 crore and it is 75 lakh. Then marginal impact on other tenant. The mall has 75,000 square feet of adjacent space, paying an average of rupees 200 square feet monthly rent, approximately 18 crore. So premium retailer impact is 5%, means 90 lakh annually, and discount share impact is 12%, which is 2.16 crore annually. And long-term stability, the discount stay offers 6 additional years of secured occupancy. So this is a comparison between the two. So now on the basis of it, how the conclusion is to be made. So despite the lower direct rent, marginal analysis reveals that the discount department store creates more total value to the property considering all factors. So the value recommends that the discount store because the total marginal contribution direct rent plus impact on other is 4.3 crore annually versus 4.1 crore annually for the premium store. Then lower tenant improvement cost improves the return on the investment. Longer lease term reduces future vacancy risk. And while capitalizing 8.5% additional 18 lakh annual contribution represent approximately 2.12 crore added to the value. So this case illustrates how marginal costing techniques help values to identify value maximizing decision that might not be apparent for a simple rental rate comparison. Next is absorption cost and its relevance to the property valuation. Absorption cost or full costing is an accounting method that assign all manufacturing costs, both direct cost and indirect cost, overhead cost, to produce or to for some services. So for IBBI registered values, understanding absorption costing is important when valuing property where cost allocation affects reported probabilities and when analyzing development project. So first we will discuss the difference between absorption cost and marginal cost. Absorption cost, it includes all costs fixed and variable, whereas the marginal cost includes only variable cost and unit cost. So it allocates fixed overhead to the cost units. It treats fixed cost as period expansion. So it complies with generally accepted accounting principles. It is used primarily for management decision making. It is used for financial reporting and tax purposes. It is not compliant with GAAP or for external reporting. So it focuses on full cost recovery and comprehensive probability. It focuses on contribution margin and break-even analysis. So how this this absorption cost is applied in the property development valuation? First, to check the development project feasibility. When analyzing development project, absorption cost ensures all costs, including land, hard construction costs, soft cost, and financing, are fully allocated to determine accurate unit cost and profit margins. Then it is also used for construction cost allocation. For mixed-use developments, absorption costing help allocating shared construction cost, foundation, common area, utilities among the different components retail, office, and residential for accurate component valuation. Then it may also be used for historical cost analysis. So when reviewing historical financial statement for income producing properties, understanding how fixed costs were absorbed help normalize operating expenses for valuation purposes. And it may also be used for replacement cost estimates. For the cost approach to the valuation, absorption costing principles ensures comprehensive inclusion of all direct and indirect costs that would incur to replace a property. So this is where this absorption cost is applied in developing properties. For example, we have a case studies on mixed-use development in Chennai. In an IBBI valuer is analyzing the proposed mixed-use development in Chennai with the following components: 100 residential apartment, 1,20,000 square feet area, commercial retail space 30,000 square feet, office space 50,000 square feet, common area and parking 40,000 square feet. So the total project cost is approximately 120 crore, including land cost. It is 30 crores. It is proportional to saleable area value. Direct construction cost is 65 crore based on the specific component requirement. Common area construction is 10 crore proportionate to component area. Approvals and permits is 5 crore proportional to component area. Designing and engineering 4 crore, which is also proportional to construction complexity, on the basis of which the allocation is being made. Then project management is 3 crore and financing cost is 3 crore. So this total is 120 crore. So on the basis of above allocation, we draw it on a graph, and on the basis of which we will be doing analysis for residential portion, for retail portion, and for official portion. So from the this graph, we have drawn all these on the basis of the calculation work. So from this slide you can say that the retail component has highest cost per square feet due to specialized requirement and higher finish standards, but also commands premium selling price of 16,000 per square feet, resulting in the highest margin of 22%. And the residential component costs 9,500 per square feet. See here, it is approximately 9,500 per square feet, and expected selling price is 11,800 per square feet, providing a 19.5%, which is within the market expectation. And the office component is approximately 10,800 per square feet with a expected selling price of 13,000, yielding a 16.9% margin, slightly lower than the market expectation. So the valuer recommends optimizing the office component specifications to either reduce cost or enhance features to improve marketability and margin. So see, on the basis of this analysis, value can also provide guidance on the residual land value and overall project feasibility, supporting a comprehensive valuation opinion. So this case demonstrates how absorption cost provides a more complete understanding of the project economics than marginal costing alone. So as it ensures all costs are properly allocated each component for accurate profitability assessment. So the last topic in this presentation is integrated financial analysis for the property valuation. So effective property valuation requires integrating multiple financial analysis techniques to develop a comprehensive understanding of the property's economic characteristics. IBBI registered values must synthesize bookkeeping data, financial statements, and cost analysis to arrive at a well-supported value conclusion. So the integrated analysis framework, we will be discussing certain key integration points. First is historical financial data. So from where you can find out normalized income, use accounting records to establish baseline performance, then normalize for extraordinary items. Then cost structure, which is used for risk assessment, to analyze fixed versus variable cost to quantify operating leverage and market sensitivity. Then break even analysis, from where you can check stress testing, apply break even calculations to test properly resilience under various market scenarios. And then marginal analysis, this is for highest and best use. Use contribution analysis to evaluate alternate property use or configuration. And then financial ratios, they are used for market positioning. So compare property performance metrics against market benchmarks to assess competitive positions. So we will be taking a case studies that will make the things clear. An IBBI registered value is asked to with a valuing a mixed use property in South Mumbai consisting of a retail ground floor, office floor 1 to 3, and service apartment floor 4 to 6. The property generates a total revenue of 7.5 crore annually. And from the bookkeeping and financial statement analysis, what the value, find out the value, reviews 3 years financial statements, identifying one-time insurance recovery of 35 lakh for water damage that inflated the most recent year's net operating income. So the valuer also notes that inconsistent classification of capital improvement versus repairs requiring normalization and adjustment. So from this thing was assessed from the bookkeeping and financial statements. Then from the cost structure analysis, what the value find out? We find out that analysis reveals distinct cost structures for each component. Retail 70% fixed, 30% variable, office 60% fixed, 40% variable, and service apartment 45% fixed and 55% variable. This explains why the service apartment component maintained profitability during a recent market downturn despite occupancy dropping to 65%. Then he carried out break-even and margin of safety analysis, from where the valuer calculate component-specific break-even points. For retail, it was 50% occupancy break, and for office it is 65% occupancy, and for service department it is 55% occupancy for break-even occupancy. And current occupancy levels are 95%, 85%, and 72% respectively, indicating varying margin of safety across the component. And see, he carried out margin contribution analysis. The contribution margin per square feet varies significantly. For retail it was rupees 850, for office it was 550, and for service department it was rupees 650. This analysis supports the current use allocation as optimal, though suggests potential value in converting some office space to the service apartment in future. So based upon the above data, the valuer carried out the valuation for retail area is 15,000 square feet. Normalized net operating income is 1.85 crore. He applied a capitalization of 7.5%, lowest on it, and the value comes out to be 24.67 crore. Office space is 45,000 square feet. Normalized net operating income is 2.3 crore. He applied a capitalization rate of 8.5%. The value is 27.06 crore. Then serviced apartment area is 40,000 square feet. Normalized net operating income is 1.95 crore. He applied the capitalization rate of 9.25%, and the value comes out to be 21.08. So total normalized income is 6.10 and average capitalization rate is 8.38% and the value comes out to be 72.81 crore. So on the basis of it, the final valuation conclusion that the normalized net operating income of 6.1 crore reflect adjustment for the one-time insurance recovery and reclassification of rupees 25 lakh in capital improvements incorrectly expressed as repair. So this is where you can check from the books of account that there is difference between capital improvement and expenses as repairs. You have to take capital improvement into consideration for net operating income, not expenses as repair. Then component specific capitalization rates reflect different risk profiles identified through cost structure and break-even analysis. The retail component low cap rate of 7.5% is supported by its prime location, long-term lease, and favorable cost structure with higher margin of safety. The higher capitalization rate for service apartment 9.25%. It reflects greater operational intensity and market sensitivity despite favorable variable cost structures. And the integrated analysis scores concluded 72.8 crore 1 crore representing a blended capitalization rate of 8.38% for the entire property. So this comprehensive approach demonstrates the importance of integrating bookkeeping, fundamental financial statement analysis, and cost accounting techniques to develop a credible, well-supported valuation opinion for complex property. So I think this is more than enough to make the things clear that how the bookkeeping and accounting part help you to improve your valuation, professional capability, competency, and how you can use this for making your valuation report different than those who are not conversant with these facts. Thank you very much and have a nice day.